Okay, let's unpack this. Today's deep dive is jumping straight into a financial market that feels, well, less like a smooth highway and more like two completely separate roads.
That's right. We're looking at the report from the 15th, and the mission today is to figure out why capital is splitting so dramatically.
Right, because you have this strange combination of forces, high interest rates, this seasonal liquidity memory.
And softening inflation pushing for rate cuts, but then you have this layer of political risk creating uncertainty. It's a really complex backdrop.
So let's start with that macro engine. We've got inflation softening, which should be good news, but then these other forces are pushing right back.
The big anchor here is the interest rate environment. The U.S. 10-year Treasury is still hanging around 4.18%.
And that number, that percentage, it acts like gravity on growth stocks, right?
Exactly. It just puts constant pressure on valuations. But then you have the other side of the coin, the inflation story.
The core CPI, which keeps getting better.
It does. It continues its softening trend. And that's the evidence the market is using to bet really heavily on future rate cuts. They see the inflation fight as, largely won.
But just as the market gets comfortable with that idea, the political situation throws a wrench in the works.
Precisely. And this isn't about economic data anymore. The sources we're looking at cite reports of political pressure, even judicial investigations around Chair Powell.
So it adds a risk premium. Even if the data is clean, the market now has to price in potential instability.
It's a volatility amplifier. Capital absolutely hates that kind of uncertainty.
Okay, and the final piece of that puzzle, the labor market. What did the December non-farm report show us?
It showed a clear slowdown, about 50,000 jobs added, with unemployment ticking up to around 4.4%.
So it's a cool down, but not a collapse.
That's the key takeaway. The market is moving from super tight to just normal. It means the Fed can see its policy is working without, crashing the economy.
All right, so that's the macro picture. It's complicated, which leads us directly to where the money is actually going. And it seems to be going in two very different directions.
Completely opposite directions. One flow is into AI and tech growth, and the other is going straight into precious metals.
Let's start with that Stacey trade. The numbers on gold and silver are pretty stunning.
They're showing incredibly strong bullish momentum. Spot gold hit a new high. Reports had it close to $4,600 an ounce.
Wow.
And silver also hit a historical high, over $90 an ounce.
So a price like that for gold, it's screaming two things. One is hedging against political risk.
Aggressive hedging, yes. And the second is pure conviction that rate cuts are coming. Gold thrives when real yields are expected to fall.
Okay, so that's the safety camp. Now let's pivot to equities. How is the broad market, say the S&P 500, handling this?
Broad ETFs like VOO are basically just grinding sideways. They're in a high-level consolidation, waiting for a clearer signal.
But the NASDAQ is a totally different story.
It is. The QQQM, which tracks the NASDAQ Q100, is being driven almost entirely by a handful of big tech names. The story there is all about AI and semiconductors.
So how is the AI narrative ignoring that gravity from the 10-year Treasury we talked about?
Because the market sees companies like NVDA, GOG, and Meta as a long-term structural shift, not just a cyclical play. Investors are betting that the AI revolution will outweigh the current drag from a 4.18% interest rate.
That perfectly explains the split. So where does Bitcoin fit in?
Bitcoin is acting as a kind of hybrid asset. It's consolidating high near that $92,000 to $96,000 range.
And what's driving it has changed. It feels more institutional now.
It is. Sentiment has moved from extreme fear to caution accumulation, and it's driven by institutional flows. ETFs, options, and big corporate buys, like from MicroStrategy. It's becoming part of the traditional finance landscape.
So given this tension, let's get to the strategy. How should you approach a market that's running on two separate tracks?
The core principle has to be defense first. You have to assume volatility is the default state right now. So that means phased accumulation, strict stop losses.
Okay, so for equities, how does that look in practice?
You use broad ETFs, VOO, and QQQM as your core. For the big AI leaders, the recommendation is phased buying on any dips. Don't chase the rallies. And maybe even consider using options for protection against any sudden shocks.
And what about the metals? With gold at a new high, how do you play that?
You need to maintain a moderate allocation to a gold ETF or physical metal. It's your systemic risk hedge. The market is telling you it's worried.
So maintain cash, be ready to move.
Exactly. Optionality is your biggest asset. You have to monitor that short-term funding data, the SRF, the RRP, and have cash ready to deploy when sentiment shifts.
Which brings us to our final thought. The market is riding this wave of falling CPI, but it is totally exposed to political and geopolitical shocks.
And that's why we're seeing gold and AI thrive at the same time.
So we want to leave you, the listener, with this question to think about. The data shows that political uncertainty and rate cut bets are pushing gold and crypto higher. But what happens if that political pressure on the Fed just disappears?
Right, and the job market just settles into a boring, stable normal. Does all that safe haven capital immediately rush back into the AI growth story, or is this dual-track market where both safety and speculation can win actually here to stay?
That's the key question, and the answer will probably define the winning strategy for the rest of the year. Something to think about until our next deep dive.